Now, before we dive in, we'd like to remind you to please like, share, subscribe. Your support is welcomed. If you have any questions, if you have any comments, please leave them in the comment. We'll get to them as quickly as we can, and we cover some of this in a bit more detail in our reports. So please reach out if you'd like to figure out or find out how to get those reports. So now we can jump right into the cumulative central bank balance sheets, because this is always fun to see when something goes parabolic and what law of diminishing returns means. So you can see in 08 to 09 how we had that spike in terms of activity across really all central banks. And then the sheer size of what we've seen over the last, let's call it, essentially almost a year now. And you can see just the sheer size and action, because law of diminishing returns just means that you have to do more to generate the same level of improvement when you're considering, apples to apples. But the problem is, and this really kind of leads to the crux of where we sit right now, there was no reduction of those balance sheets from 2009 until essentially when we started to see a little bit of a slowdown at the peak of 2018. And then there was a little bit of a flat line from 2018 to the near the end of 2019. And then you started to see a reaction of just activity. And then obviously we've gone parabolic from here. The problem is, how much more can the Fed and other central banks do to generate some sort of inflation, some sort of types of movements? And now, while today is Thursday, November 5th, so we have the Fed day. So it'll be interesting to see what the commentaries are. We try to simplify it and be like, okay, well, let's break this down. You have stalemates in politics where Biden will most likely win the presidency. The Senate is now still Republican. The Democrats have lost some seats in the House, even though they're going to retain control of the House. There's going to be a lot of friction and stalemates, which means that the central banks may have to do more. And based on, obviously, this chart, you can see they've been willing to do more. So what do we expect? Well, we have, weakening or weaker jobs numbers. We have some soft economic data. We have COVID, which is continuing to increase. And we have, in their eyes, low inflation, low employment equals dovish Fed. Dovish Fed just means they're going to continue to do more and be supportive, as they describe it, in the market. So this is just something to watch. That's why gold is obviously a big component in terms of where we sit. And in order to kind of get a sentiment of what is happening in the market, you just have to look at gold, Bitcoin in terms of just, getting away from some of the inflation, and then the US dollar to get some of those views. The dollars remain in pretty much range bound, and that's something that we've talked about in our own show, looking at the US dollar dynamics. But it comes to why we think that there's going to be more likely a stagnation or stagflation as we go through the remainder of this year, and then as we project out for the rest of the decade. So now that we looked at the Atlanta Fed GDP now, our views was that the expectations were for the Q3 to come in at about 32. As we said in our econ show, we were expecting it to be about a percentage point better. It ended up coming in at 33.1%. Again, we have the benefit of taking all of this data and coming up and making the easier decisions of saying, no, they're wrong, and they're wrong by this much. And again, we just try to take the information and put our own spin to it based on the other data points that we're connecting that may not be apparent to some, that to try to come up with a educated guess or educated numbers or figures and adjustments that we think we would make to those components. And here you can see for Q4, the expectation is for an expansion of about 3.2%. Again, this is one that we think has downside just as we start to look at holiday shopping, stimulus. And the question is really going to come down to, when does stimulus come through? And this comes back to the election, what's happening, how long can the stalemate last? Will President Trump come out and go after some of the swing states that have seen some shifts in ballots? These are things that are going to delay some of the stimulus. So the likelihood is we get stimulus. So the question is not really if, it's a matter of when and how much. So that's going to be kind of that pushback. Now, obviously, based on numbers that are out there, to be anywhere from 1.8 trillion to 2.4 trillion. It should come by the time we get into November. But if President Trump doesn't win, does he have any incentive to do anything? If he does win, will he rush it? Will the Senate Republicans try to push him to do something to show that they're still doing things in good faith? Again, a lot of ifs, ands, and buts. But the one thing that we do believe is it will be coming. And then the question is, when does it come, and how much will that drive those GDP shifts higher? And we'll talk about why does this matter as we start to look at those fiscal stimulus and how that changed the underlying consumer for the better when we look at those moves in GDP. This is a bigger problem. Again, it's a small survey. It's only about a little over 1,000, so just take it for what it is. But it's just interesting that when we start considering holiday shopping, because this is, if we start looking at jobs, if we going back to in the first segment when we were looking at employment, how employment remains contractionary, it feeds into these decisions where, what are your holiday shopping plans? 30% are saying that there's no change. About 21% are saying that they're smaller versus previous years. 39% or so are saying there is no shopping plans. And then obviously the others are saying that they're either shop last minute or no spending, this year. So it's an idea to see what is happening when we look at consumers that have budgets. And the question is, do they have budgets? And they say no. Well, does that change? Does that adjust? How does that kind of shift in terms of how much money are you willing to put in? Because when you start to take a step back and say, well, let's adjust a little bit because clearly, jobs and there's an uncertainty in the world. So now that when we look at the consumer and we take that out and we say, okay, well, what's happening with the underlying economic activity? So clearly you have the GDP that spiked higher. The question is going to be, what is the weekly economic index doing? And it's pared back a little bit. It's now at about negative 3.7, but it's important to understand that is going to move over time, and industrial production year over year is still negative. It will bounce just because when you look at the fact that this came out September 30th, we had a fairly strong October. It started to weaken into the back end of October, but it front weighted, it was strong and it had something to do. So we will see that increase in industrial production. But when we look out and we start to project into Q4, we continue to see headwinds, which is why, and if you factor in the weekly economic index, which is starting to shift lower, some of the numbers, and we'll start going through them, they're coming in expansionary territory, but they're missing estimates where they're coming in a little bit weaker than expected, and they're shying. And when you break it out into their components on how they're calculated, some of the key components that are more leading than others is showing that there's going to be additional softness, which is why when we look at this, the New York Weekly Index is just an interesting one to kind of keep tabs on to see how it's responding in the market as we see new economic data hitting. Now just looking at some of the PMI numbers. So here you have the ADP employment change. So it was well under expectations. It came in at about 365,000 versus what was expected of 643,000. Now, typically this should mean that the U.S. jobs numbers, when we look at non-farm payroll, manufacturing, and when we look at private, typically this means that will underwhelm, but there's been a disconnect between the two. So how much of that was driven based on polling, based on people that were working for the government as we prepared for the election? How much of that is being driven by Amazon? Some of the short term as we see other people leaving the workforce. But again, based on just when we're recording this, that data doesn't come out till tomorrow, so we'll talk about it next week. But it's just interesting to look at that ADP continues to show some of that softness. Now, the trade balance has gotten a little bit better. Again, not as good as we would hope, just because exports remain low. And so this, when you break it out into pieces, it's not because exports increased exponentially, it's because imports declined. And this is why when we start talking about inventories and trade, U.S. being one of the largest trade partners and one of the largest economy in the world, as our imports go down, so that has obviously reverberates through the system. So then when we start looking at the PMI numbers, and there's different PMI numbers and ISM numbers that we'll talk about, So here you can see the service PMI number did increase to the upside. Again, that was a net positive. The U.S. composite, again, remains in an expansionary territory. And the benefit is, like as we talked about, between that 48 and 52, we're at 56. So clearly there's expansion. So that's one of those positives that we continue to see that came out in October. The question is going to be November into December. And again, when we're looking at October as an aggregate, front weighted was strong, and then we're starting to see some of those declines as we head into the remainder of October into November. Now, when we start looking at manufacturing, again, it was right in line, but manufacturing on the ISM level, 59.3, new orders, 67.9, prices paid, all of them are positive. But when we start kind of looking in and breaking it down, you have to see new orders, the highest reading since January 2004. Clearly a positive. Employment also rose 31 to 53.2, the first time above 50. But the question is, what are the two speeds? Because as we showed with those jobs, we're seeing the orders increase. We're seeing some of that expansion, but we're not seeing the same type of move in jobs, which is a lagging indicator and is lagging. But when we start looking at hours worked, and we start factoring in the new investment in technology, you can kind of see the two speeds that are coming through. Now, when we look at the U.S. employment cost index, you can see that they're starting to come down, and it's which is a positive if you want to think about, well, it's cheaper to hire someone, but again, it comes to the actual spending power of the person. Because if you are making, let's say $150,000, can't find a job, struggling to find a job, you've now been unemployed for 3 months, are you more likely to take a job that pays $110,000? And that's what this is starting to show, where the cost index is coming down, and that's including wages and salaries. So again, this is something that's drifting lower after seeing a pretty steady increase from 2016 into the beginning of 2020. And that's something that's going to continue to move lower, which again comes to the spending power of the underlying individual. But it's important to understand the spending recovery as to what are things being spent on, because we talked about PMI and manufacturing, and here durable goods, non-durable goods, goods themselves, things that have to be made, have gotten better. They've gotten better from June on. It's the services side that continues to underwhelm, because if you're thinking of some things that you're going to cut, if you need a new dishwasher, you're going to buy it because that's time, that's money, that's things that, do you really want to do dishes for an hour after dinner? No, probably not. So you're going to buy that dishwasher. But the services, things that you may not need, you're going to cut. And those are things that we continue to see cut. And that's why there's that two-speed recovery of manufacturing versus the services, which is why manufacturing is important, but the services continue to underwhelm. And people are again, remaining fairly tight with their spending, which is really coming into the underlying services market. Now, when we start looking at the velocity of money, it all comes down to that total spending, the total movement. And we've talked about it. I'm not going to go through the intricacies of it just because we did that in the US dollar show, or where we called it US dollar dynamics. So here's just one where we clearly, the velocity of money remains depressed. A small bounce, but nothing meaningful to say that we're going to get this big increase in the velocity. And this is what the Fed is using when they're showing that we're not seeing a big movement of money through the system, which means that inflation will remain depressed. Given inflation is, we could do a whole show, we could do a whole teach-in. So again, let's just keep it here and just say that there has been a small bounce, but nothing meaningful, which is going to keep the Fed in a dovish mode to help support that and try to increase the velocity. But again, you can't increase the velocity if GDP is slowing. And then as you continue to increase the money supply, which is the denominator, you're dividing by a bigger number. So obviously this is a calculated number. So things inherently slow, and just the amount of debt in the system, we're just not seeing movements, which is something that is going to be persistent over the next few years. So the one thing that is a positive when we look at personal income, again, this is the Indeed.com. Their economist puts out some great work. And you can see that the personal income excluding current transfers when we're considering the payments from the system, from the government, and then personal income when we're considering where things are as factoring in the fiscal stimulus. Again, this is why stimulus was so important, because as people lost their jobs, as people lost the employment, you had that big increase in terms of $1,200 paycheck, a one-time $1,200 increase in unemployment benefits. Again, that's where we get, and it's been slowly bleeding out, which is why we want. It's very important to see when does that new fiscal stimulus come and at what size. And this is why it's important, because when we look at the lost wage assistance program, you can see just how much it increased different components, which is why April into May, obviously you had that impact payment. And then we had that continuation into the other with lost wage payments when you had the additional $600 a week. And then you have the assistance as you go into more of a permanent help after you've exhausted some of your other state and federal benefits under the unemployment. You have some of those COVID. So this is why if we get that new spike in terms of that one-time payment, which will most likely be included, it's something that's going to generate additional activity for the underlying consumer. And it's important to appreciate, as we talked about the consumer overall, because obviously the consumer is a big component. It's about 70% or a little bit greater. So let's call it 70 to 75% of the GDP calculation in the U.S. So that's why fiscal is very important, because that you can actually buy pieces of additional GDP growth. But here we have an inventory contribution to GDP. So how much inventory was generated? And you have to consider, what did the people do at the beginning of the crisis? They went out and bought. They went out and hoarded. They picked up and they cleared shelves. So what do you have to do? You have to rejuvenate that. So here you can see a huge increase in inventory that was generated to really backfill the system, which comes to manufacturing growth, which comes to the comments that we've shown in intermodal on rail in terms of trucking. It's right here. We had to rejuvenate the inventory, and that was also a big component of GDP growth. Now, the reason why we're showing this is you can see the bleed down from Q4, Q1, Q2, big spike in Q3, and this is why we keep talking about how inventories have now been replenished, and it's not gonna impact GDP to the same way, because you're gonna see some of that normalization. We're not gonna go negative, but it will become more normal and really along, let's call it anywhere from 50 basis points to 1%. And now when we start looking at trade contribution, because trade is obviously a big part of GDP, here you can see imports obviously exploded, exports declined, and then we had a little bit of a reverse, but nothing meaningful when we start talking about, how does this normalize? The bigger factor is our exports remain depressed and struggling, but imports have declined, and they'll continue to decline, coming full circle back to the inventory as that inventory levels normalize. Now, before we depart on this segment, we just want to talk about Europe PMI. So here's, again, the two phases in terms of manufacturing. So here you can see most of the manufacturing across Europe has remained in expansionary territory, with the Eurozone coming in at about 54.8 if you consider kind of where we sit right now. Germany is the biggest component of that, they came in at 58.2. The problem is going to be what happens next, because this is looking at October, and clearly there was an increase in cases, an increase in hospitalizations, an increase in deaths, resulting in lockdowns that are spanning pretty much across the board 4 weeks. And that's why we're going to see, obviously it's going to show up in the numbers, which is going to make November weaker. The question is going to be how much weaker and where does that sit, because it's going to really appear more so in manufacturing, because services has continued to struggle. So that's why we're going to look. We think that you're going to get into obviously a deflation, a shrinking component as you're going to fall below 50. And now as we look at services continue to either surprise to the downside or come in kind of fairly in line. And here you can see most of them, except Germany, are in a contractionary standpoint. The Eurozone composite was able to hold 50, again, kind of within that realm, but the Eurozone services continues to decline. And that's why when we talk about spending it's not just the U.S. consumer that is not spending as much, it's also abroad. And this is a perfect example of where we see those slowdowns. And then if we kind of break it out a little bit and make it a little bit more interesting, let's look at supermarkets. What's happening with supermarkets, what's happening with apparel. And you can see those slowdowns as we went through October. And this is why we like to talk about October started strong or flat or in a period of strength, and then has weakened over time. Which is why as we went through October and then look at October into November, that's where we see those concerns, and that continuation through November gives us pause in terms of where that growth is really going to come from. And then when we look at accommodations, obviously hotels are going to continue to struggle, which is what we're seeing derived here with accommodations coming off. And again, it just comes to restricted travel across borders. And then even within borders, you're really restricted just to jobs only, for work only, which is going to continue to hinder kind of where this recovery really comes from. And Europe is going to be a big overhang and a big drop, not only in oil demand, in refined product demand, but just in the global GDP construct. Because when you look at the Eurozone, it is a very large economy as an aggregate, which is going to be a problem as we project not only into through the rest of Q4, but also into 2021.